Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Welcome back to the Australian Business Podcast. Today I am joined with Jordan. How are you?
Good. How are you?
I'm good.
That's good. What's been happening this week in the inflection world?
In the inflection world, it's been a busy week, which has been good. Again, we've had some more people starting in the team, which is exciting. Just kind of bringing more people on board, getting them across kind of our processes and the way that we do things. What about you guys? How's Grayspace?
Good. I spent most of the week preparing for today and writing podcast outlines.
Yeah.
So
Appreciate
doing
it.
doing some batch recording, which is always good fun to do them in person.
Yeah.
I don't know, I really enjoy doing them in person. I feel like we did a couple that were an hour long as well, which is great. Really liking the longer form
content.
Yeah, that long form stuff. So balancing that Grayspace and the inflection community as well. But all is well, can't complain.
Yeah, the inflection community has been growing, which has been nice.
Yeah, for sure.
Some fresh faces in there recently.
Yeah, there is. It's good to see. And if you did want to join that free community, links in the show notes.
Yep.
Come in, have a chat, introduce yourself. We talk all things business, sales, marketing, operations, processes is a big thing.
Yep.
And finance as well, which is what we're talking about today.
And today's an important one because we are talking about financial forecasting in your business.
For sure. I think it's really important, whatever stage your business is at, to be on top of this. Look, what that is for us, we use spreadsheets.
Yep.
I'm sure there's software out there that does wonderful jobs and makes things look pretty. But for this, it's just about getting raw data and being able to predict what's going to happen in the future. Now, what does that look like? There's a couple of different ways to look at it. We've got top line being revenue or sales. So if our marketing tactics or whatever they may be, if it's referrals or paid ads, emails, whatever it may be, if that's working, how does that affect our sales?
Yep.
If sales are going to go up, cool. Do we have the people power to do that? Do we have enough people on hand to deliver the work that we're going to be continuously winning? So there's so many different factors that go into preparing these financial forecasts.
But I guess overall it helps with more educated decisions
100%,
as a business.
100%. And on that example, to go even further, when the marketing pays off, we need to make sure that we can hire someone.
Yeah.
What does that look like over the next 2 months? If there is an increase in work. So I think it's super important to have really accurate forecasts. It does help with decision making, and it helps with the strategic planning as well. That overall picture of where we want to go in the business and how we're going to get there.
Cool. And so I guess as we kind of talk about it a little bit more, we'll dive into, I guess, how we build that out. Obviously, it's not just random figures that we're sort of pulling into a spreadsheet. It is based on data, right?
Yeah, for sure. There's the process of estimating the financial forecast, what it looks like. We want to look at the previous data as well. Like you said, you don't just want to pluck numbers out of the air because we'd all love to put 6-7 figure numbers in those Excel sheets, but we need to go off historical data and then be able to look at the trends, and that'll allow us to predict what's going to happen in the future. Yep. If we're a seasonal business, there could be some economic things that we need to consider as well, some different economic conditions. It really does depend on a business, again, industry by industry, what we're going to be looking at when we are looking at that financial forecasting side of things.
Yeah. And when you, I guess, are looking at that historical data, is there sort of a rule of thumb in terms of you would typically look at 12 months? Is it a financial year? What do you look at? When
we're building out these financial forecasts, we go monthly. So I think it's important to look at the last 12 months, but on a monthly breakdown. Yep. That spreadsheet that Daniel's put together, we'll have, it's in the free community. So get onto it if you haven't seen it yet. You'll see that we've got the past 12 months, and then we look at that past 12 months and we use that as our starting point. And then from there, we go on to predict the future 12 months and what that looks like. And we've done a spreadsheet together too, where it's not just if I spend $5,000 on marketing or $2,000 on marketing, I'm going to get 2x the return. We've really refined and worked out, okay, if 2 leads come in, our average close rate is 25%. That's a bad example. Say 4 leads come in, 4 leads come in and we close at 25%. We know we're going to have 1 converted sale. So it really does help when making decisions. So if we know that we're going to get 1 sale per month, then okay, cool. We can take on 10 more sales before we need to hire someone else. Yeah. We can take on 10 more sales before we know our wages are going to increase.
Yes.
So it's super important to be able to, again, just to really reiterate that it does form part of that overall strategic planning. Yep. We need to know what our numbers are doing. for me, that's the starting point, and then we can move forward to hiring, to spending more on marketing. If we need to buy more equipment, super important to just be able to plan for the future. Now, it's really important as well is when we're looking back at that previous 12 months of data, that needs to be accurate, because garbage in, garbage out, right? If we don't have accurate data, we're going to make all of these assumptions and decisions based off stuff that isn't correct. So I would suggest using your Xero file as your source of truth. Make sure that it's up to date, make sure it's reconciled correctly and everything's been done. So that way, the last 12 months, that data is correct. I know that's correct.
Yeah. And how often would you be, once you're kind of putting this, this spreadsheet together, how often are you updating it? Is it monthly? Is it quarterly? Is it weekly? What does that kind of look like?
For us, we do it once a month, the spreadsheet, but we do our reconciliations weekly. And when I say reconciliations, we go into our Xero file and we code all the bank statements. So our data, we're always keeping up-to-date data so we can see what happened the last week or the last month. Like I said, we update once a month, and that's when we have our cash flow meeting at Grayspace. We'll sit down once a month. How did we go last month? Did we hit our targets? If we did, fantastic. If not, okay, why didn't we hit our targets? And we use that. Again, we're looking back here, but we're using that last month to make sure that we are on track when we're looking forward. So for us, it's once a month. Now, the cash flow that we prepare, it's also long-term as well. So what I mean by that is it is a 24-month projection. So we are looking a year, 2 years into the future. And again, that's always rolling. So it's a rolling 24 months. So that way, historical data is all there and the projections are there as well.
Yeah. And so that, overall helps to plan those kind of long-term goals in terms of what you want to be achieving as a business, whether it be a financial metric, whether it be a number of clients, whether it be a team size, whether it be a role responsibility. You're really using this forecasting to help determine what those goals look like in 12 months.
Yeah, 100%. I think for us, it always starts here. Again, I've said it before, probably because we're accountants, but okay, cool. If we want to grow our revenue by 25%, what do we need to do? And that's when a chat with someone like yourself, a marketing agency, may come into it. Or again, if we need to hire because we're going to get that increase, okay, cool. We need to engage a recruiter because staffing's a nightmare at the moment. In our industry, it's really hard to get staff. So it's a conversation starter between us when we're doing the strategic planning to keep prompting those conversations.
Yeah. And I guess you would use that to help. You mentioned earlier in terms of understanding kind of when you need to onboard new people and buy new equipment to help kind of that person fulfill their role. So you would use this to help forecast, those expenses as a business?
For sure. And that goes for if you were going to pay for it in cash, pay for it up front, or if you were going to pay for it on a lease agreement or some type of finance agreement. So I'll run through both of those. If you want to pay for it up front, there's going to be a large decrease in cash, right? So you want to make sure, again, you've got enough money in the bank in order to cop that big expense. Yeah. And having that spreadsheet, it's going to allow you to plan it out and see what that effect's going to be. The second part of that being the finance agreement, whatever the loan agreement is that's going to affect you monthly. And in that spreadsheet, again, you'll have a line item for your hire purchase agreement. So if it's $1,000 a month or whatever it is, you can see how that's going to affect your future cash as well.
Yeah. I guess as an example, we had some friends that opened a cafe and part of opening the cafe was getting a coffee machine. They're quite expensive.
Yeah.
And so they did it as a monthly, they paid it off over, a 12-month period or whatever that kind of term looked like.
Yeah, exactly right. And when you're doing that and you have a spreadsheet to do these things, again, it just really helps with having a really good strategic plan in place. You can see what it's going to look like in 12 months.
Yeah. What are some of, businesses that you've come across that maybe don't have these plans in place or these kind of future?
9 out of 10 businesses.
Okay.
a lot of people aren't doing it. They aren't doing it. And you're sort of just getting caught up in the weeds. I know we've spoken about that quite a bit.
Yeah.
I think that's what happens. What I would suggest is to reach out to your accountant, whoever it may be, and ask them for a cash flow statement or a cash flow summary, a budget, whatever you want to call it, and have that session with them. They can whip it up for you and they'll run you through it. And that way you can start to talk through what your plan is. If you were to do something like that, I'd probably suggest jotting down what your goals are over the next 12 months or 6 months, even 24 months. So that way you're going into a meeting like that with some pre-prepared information. You don't want to go in there and be a deer in headlights because all the numbers they're going to come from somewhere, and you don't want it to be made up. You want to be working towards a goal and working towards something that's actionable. Yeah.
And what are some of the massive or common pitfalls that you see in businesses that don't have these forecasting plans?
The biggest one is the tax time, is when it comes time to lodge your BAS or time to lodge your tax return, pay your super, whatever the tax obligation is. There's no money in the bank to do that because it's been spent. So the good thing about preparing these things is you can allocate a set amount of money aside and see how that affects your cash flow. Because if you're just assessing overall cash flow, you're not going to take into account these business activity statement payments or the tax return payments. So when you want to be able to split that out, so you have your operating cash, and we suggest doing this through 2 bank accounts at a bare minimum. If you're not going to do this exercise, have 2 bank accounts. Your operating account where you pay all of your expenses out of, you receive the money into that bank account, and then have a second account as a tax account. In that tax account, put your super aside, put the tax on wages aside. So that way the money's always there for tax time.
Yeah, that sounds really important.
Yeah, super important.
And I can imagine how scary coming into tax time would be, not knowing that information as a business owner and then getting to the other side of that and being like, oh my God, my business owes this much money and we don't have this much money.
Yeah, and it's a conversation that we always have with our clients. We always suggest at a bare minimum setting up those 2 bank accounts. And now what we're finding is when we're having these chats to do their BAS or to do their tax return, there's no shock. It's not like, oh, where does that come from? Because the money's already sitting there in that account. They know what's coming.
Yeah.
So I think at a bare minimum, if you're not going to do this exercise, you need to do that 2 bank account system.
And what happens if you're a business owner that you haven't done this and you do get to BAS time and you get the bill? What can you do?
If you don't have the money?
Yeah.
If you don't have the money, you can get on the front foot with the tax office and you can try and organise a payment plan, generally over 12 months. They're quite receptive to it, although the tide's sort of turning now that we've come out of COVID and these payment plans are getting they're getting more difficult to get over the line. So I'd strongly suggest if you haven't done any of this or you're not putting any money aside, start to do it now. If you do have a tax debt, get on the front foot with the ATO and give them a call and try and organise a payment plan while you're trying to play catch up.
Yeah. And does interest accrue on those payment plans as well?
Yes, it does accrue. So make sure you're trying to close these debts as soon as possible.
And so something you mentioned earlier as well was kind of thinking about like market trends and what's happening in the industry. How would you go about doing that sort of research? Interesting
question. I'll talk to the construction industry because it's something that I'm very familiar with. You see that a lot of people, especially in the building game, not so much maintenance, but in the building game, things are becoming much tighter. And that's just well known in the industry. So again, I would suggest having that cash buffer there. If you can see something coming, you want to be able to prep for it. So again, it's just planning for that rainy day, and that doubles down to that bank account structure that we're talking about, or all these financial forecasts where if sometimes in these forecasts, revenue isn't going to go up, it's going to come down. So if revenue is going to come down, what moves do you have to make on the expense side of things to be able to prepare for it? Do you need to lay people off? Do you need to sell some equipment? There's a couple of different ways to look at these spreadsheets.
Yeah, and I think overall it sounds like being as proactive as possible
100%.
in this situation is really important.
Yep, 100%.
Yep. Okay, interesting. And then I guess when you're thinking about doing that financial forecasting, obviously I assume there's a few ways that you would go about it and a few different methods that you would use. Could you talk us through what some of those methods could look like?
The main one that we use is again, it's Excel, where we have. I'll try and explain it. I'll try and explain the spreadsheet. So think of the spreadsheet as a profit and loss statement, but in the profit and loss statement, there's only income and there's only expenses. So we're missing out on all of the balance sheet items, which are all of your assets and your liabilities. Top part of the spreadsheet, income and expenses. Second part of the spreadsheet, we're taking into account those balance sheet movements. So we're taking into account liabilities, so our tax payments, and we're also taking in, you're looking at me funny. Are you not following?
No, I am. No, I'm trying to picture it.
Yeah, you've seen it. So
I have seen it. I
visualize.
Can picture it. I am.
And then in that second part, we're also taking into account, the main thing is the hire purchase agreements, right? Because we're paying these amounts monthly and that doesn't go into our profit and loss statement. So when we look at the cash flow statement, we want to make sure that we're taking everything into account that affects what happens in the bank. Now, Daniel's done a better job than me at explaining this. We'll have a link in the show notes to hit the video that he's done along with the spreadsheet that I'm talking about. And I'd strongly suggest getting on top of it and giving it a go yourself, because he walks through how to do it. Even if it takes you a couple of times, a couple of run-throughs to understand what he's talking about, super important. Spend the time to understand what's going on, because at the end of the day, you can't just bury your head in the sand and go, I don't understand it. Yeah. There's enough resources out there to get an understanding of what's going on.
Mm-hmm. And how often would you be like reviewing, adjusting sort of these forecasts?
Like I said before, we do it monthly, and I'd strongly suggest at a bare minimum, do it quarterly. Yeah, if you can. If not, then once a year, every 6 months, when you see your accountants to do your tax return, just let them know, hey, when we do our end of year catch up, can you prepare a cash flow for me based off the last 12 months? And that way, when I come in, we can run through what the next 12 months could look like. So start having those conversations with your accountant as well.
Yeah. And what do you do, I guess, in a situation where you've made these forecasts and, you know, at the end of the month or at the end of the quarter, you've then gone and compared, I guess, the actual performance against those forecasts and figured out sort of what those variances might look like. What do you do in an instance where you haven't met your targets? Yeah,
I think you need to adjust. If you've overshot things, then you need to pull the reins back in, whether it's top line being revenue or if it's an expense that you've overshot, you need to just bring that back in. And I think that's why it's important to do it, if you can, every 3 months, because you can stay on top of things. Whereas if you wait 12 months and you realize, wow, this person, I've sort of wanted to get rid of them for the last 2 months and now it's been 6 months. Well, that's maybe cost you 60 grand if they're on a $100,000 salary.
Yeah, of course.
That math doesn't work, but yeah, call it 60 grand.
Yeah.
So I think when you do these exercises, it really puts things into perspective, especially around staffing, because it's a crap conversation to have. But if you need to let someone go, well, now you see how much it's actually costing you. If they're costing you 10 grand a month, like I said, and it's 6 months, that's $60,000. You want to be able to visualize these things to make those conversations a bit easier.
Yeah. Yeah. I can imagine that's, so important. And I guess obviously staffing is kind of one resource in a way. What are some of those other resources we could be talking about?
The resources that we look at really closely are our marketing costs.
Yeah.
So how much we're spending on marketing, are we getting a return on that? If so, what does it look like? I think it's very industry specific. If you're a service-based business, again, it's going to be staffing is your biggest cost. Rent, your motor vehicle costs, if your industry is heavily reliant on motor vehicles. If you were in the e-com space, the things you'd be looking at, again, it'll be your sales. How much is your inventory costing you? So what's your cost of goods sold? What's your gross profit margin? So what's the profit after those direct costs? And then again, things like marketing, staffing. If you're using 3PL, what's that costing you? What are your delivery costs? Transaction fees add up very quickly. If you're doing $10 million and you're getting charged 1%, that's a substantial amount of money. So all of these little things you want to be looking at as constantly as you can.
Yep. Yeah, absolutely. What other kind of tips would you have for people? Obviously, we've got Daniel's kind of spreadsheet that everyone can access. What other tips would you have in terms of helping people, I guess, like set realistic goals, track their progress? What would that look like?
Yeah, I think in order to set realistic goals, look at what you've done in the last 12 months and then just slowly bump that up. If you set a revenue target, you want to think of the other things that are going to be affected by that. Again, I've said it a couple of times now, but there's staffing, marketing. Are you going to need to get a bigger lease in order to service all the work that's coming in? So there's a variety of different things that come up. And I think to start easily, just start with a budget. Just start with a budget. Everyone knows what a budget is, what it looks like. Start there, and then you can add that second part of the statement that we've spoken about. Again, check out Daniel's episode because he runs through it line by line. And I guess also involve as many people as you can. If you're a one person band, then it's just going to be you and your accountant. But if you do have a team, I would bring them in as well. That management level team, and just get as much input as you can.
And would you bring them in those early stages of that conversation when you are setting that budget, or maybe once that's put together? What's that right time frame look like?
Yeah, I would say once it's been put together, and then just so you're saving time more than anything, because it can take a bit of time to put it together. So once it's put together, then call the meeting, and that's when you can run through it and chop and change things if you need to.
Yep. So I guess it sounds like start simple if you need to, start simple while you can, and then add that complexity over time.
Exactly right. I think to summarize, you just want to really make sure that you're setting some clear objectives of what you want to come out of the exercise with and where you want to be. Have some assumptions as well. Even have 2 different scenarios. That's something that we've done a couple of times where scenario 1, shoot for the stars if things were to come off, and then have a more realistic scenario if things weren't going to move as quick as they have been in the last 12 months. Because sometimes you can have a really good period of time and a really bad period of time. So we scenario plan where we'll have 2 versions of the same thing. I think that's really important, and just review and adjust as often as you can. And if you don't understand something, reach out to your accountant. Any accountant would understand this stuff. And again, if you're still stuck, reach out to us at Grayspace. We'd be more than happy to have a chat. There's a link in the show notes below where you can book a call with myself or Daniel, and then we can run through your cash flow once you've filled it out.
Yep. Yeah. I feel like that was a really great episode for people that are new to business, thinking about starting a business, but also if you've been in the game for a long period of time.
For sure.
There's still a lot of golden nuggets in there.
For sure. Awesome.
Thanks so much, Jordan.
No worries. Thanks, Sarah.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.